Good Monday morning, Market Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. How you doing this morning, Dave?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to help answer your questions, provide you with guidance.
Awesome job.
Let me share my screen. If you guys are joining us for the first time, the reason we do this show every morning is to answer questions you may have about Market Chameleon tools, data, analytics. If you want to discuss strategies or something unusual you've seen in the markets, you're welcome to ask those questions or come on a show and ask those questions live. You can put your question on the live chat on YouTube, type it in. Will's watching it, he'll read it back to me. If you want to come on a show, we provide a link to Zoom. Click on that link. When you get to Zoom, there's a little button, raise your hand at the bottom. Click on that. You don't have to turn on your video camera. Once we let you in, everybody could hear your question. You could ask your question live and direct. While we're waiting for questions to come in, what I'll do is take a look at the pre-market report, see what's trading at pre-market hours. Then I'll navigate to a couple other reports just to get some market insights, maybe default to some questions you said we had left over from last week. Is that correct, Will?
Correct. I think they were asking about Skew and the SPY. Okay.
So we'll take a look at that. If questions do come in, stop me, let me know so we could take those. Okay. So pre-market report, these are stocks trading in the pre-market hours over here. And we could see here, we have a list of stocks that are most active stocks, biggest percentage gainers, biggest percentage decliners. When we come down, take a look at the list, we see 40 stocks made our percentage gainers list, 128 on the percentage decliners list. And so from this perspective right now, we're looking like we're setting up for a bearish bias at the open. But if you notice, you look at the list, there are a lot of small cap stocks in there, ETFs, leverage products, anything really that is listed on the major US exchanges that can trade, and traders in the pre-market hours can make this list. And we want to narrow down this list to get a little bit more insights. So what we'll do is narrow down the list to S&P 500 companies. Okay. To do that, I'm going to use the filter up here. So you have all these filters to select from. Let's do the one in ETF. And dropping it down, you get to select from a list of ETFs. The first one, SPY, is the S&P 500 ETF. Let's select that. Now, when we do that, you filter out the list below by stocks that are holdings in SPY. Okay, which are the S&P 500 constituents. In here, we see one stock made our percentage gainers list, 25 on the decliners. So from this perspective, we're also setting up for more bearish bias at the open. Let me see if there are no questions yet. I'll default to what you said last week. There was a question left over with Skew.
Perfect.
Okay. Let's go to SPY.
I have a question just popped up from
Okay.
Orange List. He's asking, hi, Dimitri and Will. In MC, is there a way to screen options with the following condition? The front month volatility is higher than the back month volatility through different expirations. I guess, and correct me if I'm wrong, Orange List, that the difference between the volatility in the different months, is that what you're looking for?
Yeah, so
there's front month volatility is higher than back month volatility.
Right. And there's let me just take a look at something here. So if you look at we do have a screener by expiration. So this is a screener where, here, let me filter that here. Example, if I type in SPY here, you could see that it lists here SPY, and you get a bunch of different SPYs, and that's based on the expiration, monthly expiration, and you get stats for that expiration, for that options expiration. You get at the money, days till expiration, the change in implied volume, open interest, and so forth. It doesn't filter out by months, based on if IV is higher than this month or that month. So the one way you can do it, if you really wanted to, is you could download this entire list. So you click that download, and in Excel, then you could filter out how you want it, right? Because you could see there's many different expirations in there, different implied vols. And not only that, you got lots of different stops here with lots of different volumes and so forth. So if you wanted to, simply compare a specific expiration month versus another expiration month, there's lots of different combinations you could do. The easiest way to do it is just to put it in Excel, just download it, put it in Excel, and it gives you all the flexibilities, because then you could, delete data, analyze data, create ratios, spreads. So we give you the ability to kind of go in there and do it in an Excel spreadsheet, which is ultimately, you got maximum flexibility, right? And that's what people would do. Just go in there and say, okay, here's the Excel spreadsheet, filter me this expiration month to this expiration month, this much of open interest on the expiration month, this much, maybe volume on the day. You could do it that way. You could do minimum at the money. Then once you filter it out, you could create you could create your ratios, this minus that, or this divided by that. And that way you get to where you want, because the question you're asking me would involve anyway more and more filter, right? More questions that you will have, and you will want to manipulate that data. And that's the best way you could do it, is just say, okay, here's the data. You could download and start using filters, and some people, once they get the data in, you could even write different types of macros or whatever you want in Excel. So that's the easiest and fastest way to do it.
Well, he says thank you, and that was helpful. We did Baiju came on. He said, here for the SPY skew explained. He's saying the VIX being so low, any relationships or inferences there?
Okay.
So I guess he saw the title of the show, and that's why he came on, because he was interested in SPY skew.
Right. So it's a good question. So as far as, I'm going to go to the options chain. Let me see how I could really explain this the best way. So the question is there a relationship between the VIX and the SPY skew and implied volatility? And the answer is yes, because the VIX is a derived calculation. Okay, so the VIX itself is basically a derived metric. It's like a mathematical formula with logic, okay, like a methodology and logic. And that comes from observing the option prices in SPX, which are going to mirror the implied those implied volatilities are going to mirror what's in SPY. Okay, so SPY and SPX implied volatilities are, correlated. So if you run implied volatilities through similar months, similar strikes, taking into account some differences with European and American, but you're gonna have something that's correlated. Okay, so what is the VIX? First of all, when we talk about the VIX calculation, the VIX itself takes into account skew. Okay, the way the VIX is calculated, it's not only implied volatility, but in that calculation, skew impacts the value of the VIX. All right. So let me take a look here, and we'll start out with what's the starting basis. Well, what's implied volatility? You go, let's say 30 days out. This is 29 days out. So the VIX follows number one. It's a 30-day constant maturity, meaning that the calculation is trying to say, if we had an option with exactly 30 days to maturity, 1 month, okay, what is the implied volatility of that? So it doesn't look at implied volatility of, let's say, February 6th. This is 6 days to go. That's not what the VIX is. It's not 6 days to go. It's not 1 day to go. It's not 1 year to go. The first thing is, you have to understand, it's looking at a 30-day, 1 month implied volatility. So this is very similar to, see, we have here 30-day IB. And this is pretty much, when we reference implied volatility, the standard is 1 month. And initially, we only had monthly options. Now we have weeklies and even, daily options and so forth. But what does it do? First, you have to understand 30-day implied volatility, but we don't have a 30-day every day, right? So right here, it's 29. Well, this is 29 business days. It looks at 30-day calendar, but you don't have an exactly 30-day calendar option every day to observe. And in order to get that benchmark 30 days, they come up with a formula, which is a weighted average of expirations that straddle 30 days. So you're going to have an expiration that has less than 30 days, calendar days, and you're going to have an expiration more than 30 calendar days. You're going to look at both those expirations, and you're going to say, well, the implied volatility of this expiration is this much, the implied volatility is this much. I'm going to do a weighted average between those two expirations to come up with what a 30-day implied volatility would be if it existed. Okay, so it's an interpolation of what it would be if it existed based on the surrounding data. Okay, so it's an inference, number one. And then the VIX doesn't just look at the money ID. So here you could see that implied volatility, let's say the stock closed close to 406. So here's the at the money IB, 16.7 in the calls, 16.7 in the puts. So at the money, let's say 16.7 on the 30-day, right? We have 16.9 because we are using also weighted average. But that's just the at the monies. The way the VIX does it is it says, okay, we're not just looking at these implied vols. We're going to look at implied volatilities of all the options going up and all the options going down. But they're all different, right? Here's an 18.8. Here's a 19.5. Here's a 19.6 implied vol. So which one do you use? They're not all the same, right? The VIX only comes up with one number, right? It says, here's the VIX. This is our calculation. This is where we're at. But there are many different numbers on the board. You have different implied volatilities for different strikes. You even have an implied volatility for a bid. You have an implied volatility for an ask because there's a market, right? The bid indication is a different price than the ask indication. And if they're different prices and you input them into the Black-Scholes model, you're going to get a different implied vol, right? So then you got to come up with a methodology and say, well, how much, if I'm going to include all of them and create an average, right? I'm going to just say, well, what if I wanted just to create an average of all of them, and that's the VIX? Well, then you have to come up with a methodology of how much weighting do you give to each of these, right? Then you have to come up with, how do I treat them if there is, for example, no bid, right, in options? Or what about the options that are very wide, like the puts, in the money puts? These are under parity. This is way over parity, right? Here's 35 implied vol, right? So the bid is 0 implied vol, ask is 35 implied vol. You could go the same thing in deep into money calls, right? Well, here's a 45 bid in the implied volatility, but this is an option that's only 7 cents. So here's an option 45 bid, almost 45 implied volatility, but it's only 7-cent option that's 32% away. So how much weight do you give this option versus this? All right. And they explain it, so you could go and look at their methodology. They do stick to a methodology and tell you how they calculate the VIX. But when they calculate the VIX, keep in mind that it is looking at a lot of stuff like this. It's looking at all this stuff, right? And putting it into a model calculation with logic and methodologies and so forth, looking at different expirations, and then coming up with a number. Okay. And a lot of people, I think, when they tend to think of finance and they look at a number, they think, well, this number is just like an exact observation, like a stock price. So stock price is easy because somebody bought and sold it at exactly that price. So that's something easy to observe. But when we look at the world of finance and using models, these are really going through methodologies and estimates and logic and so forth. Like, for example, GDP, right? Let's say you have a GDP number and they say GDP grew at 3.2%. But really, how do you calculate it? You're trusting that this number methodology and we're following it, but there's no way to really accurately say this is our gross domestic product. Like right now we're doing a video, right? We're doing a video. Hopefully you guys are learning something, but how much did that add to our GDP, right? Who knows? Did it add 0 or did we get some value out of it? So there are methodologies all over the place. Unemployment, the LIBOR rate. Anybody look at the LIBOR rate, how it's calculated? You get a LIBOR rate and you're like, here's a rate, so it's 3%, right? But where did that number come from? It's actually coming from taking the average, taking a bunch of numbers, throwing out the top 10th percentile, lowest 10th percentile, taking an average of median, with all these inner banks. So if you look at it, it's a methodology with, formulas. So that's how the VIX is. The VIX is, when you observe it, keep it in mind is it's doing lots of stuff and you cannot yourself recreate it, right? You cannot really say, here's an asset, I'm going to buy VIX. It's a calculation that you're following. And is it taken into consideration skew? Of course, because what's happening is that these wings out of the money options and of the puts and out of the money options in the calls are inputs into that calculation. And if they're inputs, that means the skew will affect the output, right? And I'll leave it up to you guys to go look at the, I'm not going to discuss, the Vix calculation. That's probably like a very long webinar. But it does take into consideration the skew, also a horizontal skew. If you look at how the Vix, like the VXX or whatever, how they try to track the 30-day, you're buying 1 month, selling another month, right? Well, if there's a difference in implied volatilities between those months, then you have a horizontal skew as well that comes into effect. So I guess the answer to the question, Vix, is does it take into consideration skew, and is it correlated to like SPY, implied volatilities? And the answer would be yes, right? Because SPY, implied volatilities, will start to mirror the SPX implied volatilities, or you could have an arbitrage type of opportunity. Maybe not an exact arbitrage, but they shouldn't go far apart from each other. And the Vix calculation does take into consideration the wings, in its calculation. Does that help? If I understood the question correctly.
Yeah, that's very helpful, D. Thank you.
Okay. All right. So yes, and I think there's even in the beginning, there's even like a debate, can the Vix calculation get manipulated by somebody who wants to, like, say, take a really like out of the money put, right? And if I bid this up, by 2 or 3 cents, the implied volatility can go from 45 to 50, let's say, just by bidding up one wing. So there's those debates too, and how much weighting and so forth that they're giving. But like, think about it as somebody has a position on, can you manipulate the Vix calculation by taking a out of the money option, out of the money wings, right, and bid it up by a couple pennies to move that Vix calculation. So there were those debates too. I don't know how they handle that, but that was going on as well, right? If that could be done. And I think they do have safeguards in place, that shouldn't happen, or they do have certain things in there, they're monitoring it because they don't want anybody manipulating it. But you could imagine, like, taking the wings, bidding this up 5 cents. Well, the implied volatility in this is much easier to move than the at the money, right? Because you bid it up, and the implied volatility of an out of the money option will jump sky high. So those are things to think about.
Awesome, D. Well, Baiju was very thankful. He said, Dimitri is a true market practitioner, goes in depth, still keeps up with the explanation. Totally makes sense. So
well,
thanks
you
for the question, Baiju.
Really
great job, Dima.
Thank you. Really appreciate it. All right. Well, we're right up against the bell, so I'll just leave it there. And maybe, if there are any questions, we'll maybe start on those tomorrow.
Awesome job, Dima, as always. Thank you, my friend.
All right. Thanks, everyone. Stay safe out there. Have a great trading day, and hope to see you guys tomorrow.
Trade in peace, communities. Have a great day, everyone. Bye-bye.
Bye.